She's Nuveen's CIO and Global Investment Committee head. Saira, it's good to see you. I mean, again, statistically, let's just think it's got to be impossible to repeat the terrible first half performance we just had. But where do we go from here?
Thanks. We doubt history repeats itself, but there's three things we're focused on for the second half. That's inflation. When will it peak? Earnings, are they the next shoe to drop? And of course, valuations, where we're at historical levels. For inflation, we're seeing some cracks in demand destruction from Richmond Fed, consumer confidence, Michigan surveys. That's good news for inflation, but the timing of when it will moderate is unclear. Now, earnings, I think, are the real risk for the second half. We don't think second quarter earnings will show cracks in terms of the reports, but the outlooks are going to be murky, and estimates really haven't come down, and that's going to be the issue for the rest of the year. It's the E in the PE that's at risk, and valuations at historical averages are supportive for the market. But until inflation shows signs of breaking and we can see the Fed take their foot off the gas for interest rate hikes, I don't think you're going to have much upside beyond 4,200 on the S&P.
Well, I think the earnings piece of this is really interesting. Art Hogan yesterday was saying he thinks estimates or earnings will go higher, actually, which kind of bucks the usual trend. But there are plenty of people who at least think they won't fall much further from here. So what makes you more bearish?
Well, first quarter, we did see across the board beats on earnings. And for the prints for Q2, we think earnings will still beat to a more moderate degree. It's third quarter and fourth quarter where we're worried. It's going to be the companies that have pricing power to overcome their already peak margins and cost pressures. Those are the companies that can do well, but you need to be selective because I think the estimate, the positive revisions going forward after second quarter are going to be much tougher to come by.
So it's funny because these two very issues came up with Art yesterday. So we talked about earnings and whether they're going to be revised higher or lower on the market multiple, which of course then, is based off of that 16 times forward multiple. Does that seem reasonable to you, or what are you guys anticipating?
It's about average in terms of historical valuations. This probably depends on whether we hit a recession, how deep it will be. In a recessionary environment, I think market multiples go lower also. Our outlook is more of a moderate to soft recession going forward. So I think that historical valuations aren't terrible. But again, is the E accurate? And I think earnings are the risk here. That'll be the next shoe to drop, while valuations have already moved down about 5 or 6 points year to date.
Yeah, and I want to mention a couple of the names in particular you like here. But a final point to go back to your first one on inflation. It was interesting. I mean, look at the 10-year today. We're back to 3.10. And a lot of this seems to be coming from the surprisingly negative CPI print we got out of Europe. That was on a monthly basis, but to see it drop at all was kind of a welcome sign. At the same time, you still have this upward push on energy prices. So where do you kind of look for the inflation story in the next couple of months and the implications for the Fed?
Well, energy prices, we expect them to remain high because of the tight supply-demand dynamics. Looking at inflation, we are starting to see cracks in that narrative because of the demand destruction, the pessimism of the consumer. I think that does eventually lead to inflation leveling off. The question is, when will we consistently see it for long enough so that the Fed can stop talking about such aggressive rate hikes? And they're going to need to see more data than 1 or 2 data points going forward. You will see what the U.S. CPI number looks like when we get that the next time. But we don't expect to see consistent moderate reductions in inflation prints for a while now.
Yeah, I'm looking through here. You guys, we talk about stocks, obviously, but you also have plays that you like in credit. You like some of the high yield munis here. Real assets, farmland, that's going to catch a lot of people's attention. I have to say, this is one of the conversations the past year or two with everything going on with inflation and COVID and apocalypse now and all the rest of it. I'm just curious if you want to kind of recommend anything for individual investors on the real asset front that we wouldn't normally talk about.
Well, the themes that we're talking about are, where are you really getting paid to take the risk? You can't just take any risk now and hope to get rewarded. So where really are we getting the best risk reward? This is publics over privates, because publics have really priced in a lot of the real-time issues. Credit over equity. Some of the yields on high yield and also municipal bonds are actually looking quite attractive at this point. And then real assets are a great inflation hedge. So think about farmland. We know there's higher food prices. This leads to higher crop prices, higher land values for farmland. They have built-in escalators for inflation and consistent cash flow. So those are alternative areas where we're finding value.
A lot of work, though. I mean, people think it's hard enough being a landlord. Go ahead, try to hire someone to run a farm. Let us know how that goes. No, it is absolutely a huge discussion point. Quickly, on your stock picks, I see Valero, I see Salesforce. Is that right? A couple of things that jump out to you here. Salesforce has been a tough one, but everything's been tough.
A balance of growth and value here. We're not in one camp versus the other. Growth stocks tend to perform well during periods of slowing economic growth, which is what we expect. But you need to be selective. We're not talking about unprofitable tech or conceptual companies here. These are solid companies like Salesforce, the push to digital and also cloud computing. And also then on the value side, we like energy, tight supply. Demand still isn't back at 2019 levels. And Valero is a refiner. They tend to benefit as more barrels come out of the ground.
Yeah.
We think Russia's supply continues to decrease, and also the SPR reserve should expire in October. All that's positive for energy.
96% capacity utilization for refiners right now. I mean, it is shockingly high, astronomically high in a name in that space. Saira, thanks for your time today. We really appreciate it.
Thanks for having me.
Saira Malik joining me.